Ask everybody to stand up for a minute because, the law stuff was kind of fun. That's why we have LA Law, we have all these legal things. Everybody stand up because I'm going to put you to sleep. Or I'm going to try not to anyway. All right, nice big stretch. And then we'll sit down and we'll jump into this. We're going to talk about, everybody hears that lending's different today. It's so hard to get a mortgage, right? Has anybody heard that before? Okay. Well, it is and it isn't. There's money available. People are making loans. So I'm going to talk a little bit about what we're going to do today. First thing we're going to talk about, one of the neat things about real estate investing is we can do it with other people's money, OPM. We're going to talk a little bit about a return on investment in home prices. And Jason talked a little bit about this today too. But we're going to talk about a little bit more. Types of transactions that we're going to look at. Property types, whether it's going to be condos, houses, townhouses, multifamily, different kinds of options you might see for loans. The 5 C's of credit. What do you need to do to get ready? Closing costs, special programs that are maybe outside of the box a little bit, and getting ready for the loan process. So what is OPM? The neat thing about real estate investment, let's say you want to go invest $100,000 in a mutual fund or into stocks or whatever else, you've got to have $100,000, right? Well, the neat thing about this is with OPM, you don't have to have $100,000 because to buy a $100,000 piece of investment real estate, you really only need about $20,000 to $30,000. But your investment is still $100,000. So you're going to use other people's money. That would be lenders such as banks, mortgage companies, private investors, and so on. The benefit of OPM, it lowers your initial investment out of pocket. So you can make a quality investment with a lot less money out of pocket than you could in other types of investments. The return, however, is based on the entire purchase price. So if that property goes up 5% in value in a year, that 5% is based on the entire price of the property. However, your investment in that property is your down payment. Who provides OPM? For conventional loans, Fannie Mae and Freddie Mac. Everybody heard of them. They've got a bad name. They've kind of got a bit of a black eye these days. But Fannie and Freddie are still providing a majority of mortgage loans available today. That's done through mortgage-backed securities that are sold on the secondary market and make more money available. For banks, they come from investors, and there still are banks that do this. Kind of the old school, they take in deposits and they lend it back out. Okay? Not too many of them, but there's a couple community banks that we work with. Private investors, these are like hedge funds, individuals with money to lend. They'll do the stuff that's a little out of the box, and we'll talk about that later. What is your return on the real investment using OPM? Let's talk about a duplex, $100,000 down, 20% down, $8,000 in closing costs and prepaids. We'll talk about that a little bit later. Rent on each side is $750. You're looking at $1,500. Your mortgage payment, principal, interest, taxes, and insurance. That's what PITI is. $759. So your net cash flow is a positive $741 a month, or $8,892 per year. Now let's factor in an appreciation rate, and it's based on the price, not the cost, at 4% or $4,000 a year. Remember we talked about a $100,000 property. $4,000 appreciation plus your $8,892 in your investment, and your rental return is $12,892 per year. And this is kind of some neat numbers. Your 5-year return is $64,460. Your cost, $8,000 initial for your closing costs, $14,000 for your tax and insurance, total of $42,000. Your rate of return is 193% in 5 years.
Where can you get that?
I don't know of anybody else that's returning that kind of thing. Now, where did I get that 4% return? This is the housing price index for this immediate market area over the last 32 years. And yes, we had a little bit of a bump here, which was, frankly, a little out of the box. We saw prices in the last decade go up tremendously. It was way out of the norm. You can see the normal track record follows a more normal path. And we're pretty much back in line with that path now, as you saw in Jason's chart earlier. So and this is about a 4.55% average annual return over the last 32 years. All right, so we'll talk about transaction types. Resale. Resale simply from one owner to another. A short sale, and Chris had mentioned this a little bit, but a short sale, it was the owner is the last buyer of the property. However, they owe more than the sales price. And this is fairly common these days. In this case, the lender or lenders, and I've seen as many as 3, have to approve the sales price and agree to take less than the amount due on the loan. Did I get that about right, Chris?
Yes.
A foreclosure sale is what happens when they don't follow that path, and this is one of the things Kristen likes to try to help people avoid, is where the bank or the financial institution has already taken title to the property and are reselling it. Those have gone down considerably in the numbers over the last couple of years, which is one reason we're now getting close to a 6-month inventory of property. Property types that you might want to consider for investment: single-family residences, a single-family home with freestanding property. They're the easiest to finance for investment. Typically, you can do 20% down. There's no real issues other than the condition of the property. Condominiums. For investment, this becomes a lot tougher. Condominiums, typically you're looking at 20 to 25% down. They have to be fully approved for conventional financing. And what that means is we're looking at more than just the borrower. In this particular case, we're looking at the condo association, we're looking at the reserves, we're looking at the delinquencies, we're looking at the owner occupancy ratios, we're looking at a lot of things that requires that the condo be approved for conventional financing. When I talk about conventional, I'm talking about that Fannie Mae and Freddie Mac loan. Okay, those are where the best rates are. So very few condominiums in South Florida are approved this way. Now, for owner-occupied or second home, there's a limited review process, but it's not available for investment. The rates are slightly higher than for single-family residence. Multifamily, 2 to 4 unit properties. It's more similar to the single-family in that you don't have to worry about the association or anything like that. You're looking at typically 25% down, slightly higher rates and appraisal costs, but your rate of return on those, because you've got 4 units yielding you rent on a 4-plex versus a single unit, so your rate of return is much more attractive. Okay, let's talk a little bit about loan options. The types of loans that are available for the investor is, of course, your conventional Fannie Mae, Freddie Mac loans. Those are fixed rates or adjustables. Now, ARM's kind of got a black eye along with Fannie and Freddie because everybody's like, oh, I don't want an adjustable. But in some cases, especially for short-term transactions, adjustables are very attractive. Let's say you want to get into a property and you don't want to be in it any more than 5 or 6 years. Why would you pay a higher premium in interest rate for a 30-year fix when you have no desire to keep that property for 30 years? That's when we talk about an adjustable. We don't do any kind of those weird kinds of adjustables that were done back in fact, you can't even find them anymore with negative amortization and some of the other nasty features that really cause a lot of problem with the housing crisis. Typically they come in 30, 15, 10, and also 20-year terms. Those typically have the best rates and costs because frankly they're subsidized. Right now the federal government is keeping mortgage rates down through the purchase of treasury securities and mortgage-backed securities and other things that they're doing to keep rates down below where they probably would normally be. Right now we're seeing 30-year fixed rate loans at around 4% for owner-occupied into the mid-4s for investment properties. It's very, very attractive, the low cost of funds. Yes, sir?
Can you put a cap on
All ARMs are capped. Typically, the caps on an adjustable rate loan are what's called either a 5.25 or a 2 and 6. What that means is when you hear numbers like that on a 5.25 ARM, that means it's a 5-year fixed rate or